Hi everyone, and welcome to the financial management learning session. The subject or chapter is personal financial management. We've been studying this chapter. Today we come to the final subtopic, which is financial alterations. We've been studying each subtopic at a time, and at the end of every lesson, I've been giving you assignment. Today, our focus is on the last subtopic, which is financial alterations. Financial alterations in relation to personal financial management refers to the different adjustments or adaptations that may be required in personal financial management. We all know that personal financial management is a continuous process that requires adjustments and adaptations throughout the life of an individual. And that is especially true during significant life events like retirement, estate planning, and family budgeting. And those are the three areas we are going to study in our today's lesson. We will look at the financial alterations for retirement, financial alterations for estate planning and tax planning, and also alterations for family budgeting. Welcome to the lesson. Let's begin with the financial alterations for retirement. Financial alterations for retirement. Now, candidates, in personal financial management, it's important to plan for retirement, what we are referring to as retirement planning. As individuals, we should not live as if we won't retire. Retirement is inevitable. Retirement refers to a period when one may not be able to work. One may not have the strength to go to work or do the normal things that we do in life. That is a time when the body becomes weak, the body slows down, the mind becomes also weak in processing information and all that. So it's important, while one has the strength, while one has the money to plan for that stage in life, develop a comprehensive retirement plan that includes your desired retirement age, income sources, expenses, healthcare needs, and so on. Do you understand? In personal financial management, there are certain alterations that may be required. One is in relation to retirement planning. One has to have a comprehensive retirement plan that includes desired retirement age. Within this plan, there has to be desired retirement age. At what age do you plan or desire to retire? Is it at 40? Is it at 50 years? Is it when you are 60 years? That has to be done when you are still young, when you are 20 years, 21 years. What is your desired retirement age? What will be your income sources? When you hit 70, when you hit 80, what will be your income sources? That has to be predetermined when you haven't reached the retirement age yet. Income sources. Will you be having maybe sources from rent, real estate, or what sources you have to include. Expenses. What will be the desired expenses? When in retirement, what expenses are you likely to incur in retirement? How about healthcare needs? Healthcare needs. When one is young, one may not have much in terms of spending on health because the body is active, the body is healthy. But as we age, the body's immune system becomes weak. So it's important to plan how you are going to meet your healthcare needs while you are still young. So these are some of the alterations as far as retirement planning is concerned. Do you understand? Number 2, savings and investment. Savings and investments. Savings and investments. Savings and investments. It's important to maximize contributions to retirement schemes or accounts. When you are young, you need to have some savings. When you are young, you need to invest in long-term investments that will generate returns in the long run. Do you understand? Savings and investments. Savings and maximize contributions to retirement accounts so as to accumulate sufficient savings for your golden years. Personal financial management. Save for your retirement. Invest for your retirement. You can only invest if you save. So save, then invest, so that during your golden years, your life is easy or your life is as desired. Number 3, debt management. It's important for individuals, as an individual, to pay off or manage debt before retirement to avoid financial burdens in your later years. Plan to clear your debts before retirement. These are alterations that are required in financial management, personal financial management, debt management. Manage your debts, pay off all debts so that there is no strain, there is no burden in retirement. 4, social security plans. Social security and plans or pensions. Before getting into retirement, it's important to understand your eligibility and benefits from social security and any other employer-sponsored pension plans. Understand that in advance. 5, healthcare planning. One ought to consider potential healthcare costs in retirement and research Medicare and other insurance options. Because one of the thorny issues in retirement is the health of an individual. So it's important, critical to plan for for one's health, what we are calling here healthcare planning. Healthcare. Consider potential healthcare costs that one may incur in retirement and research for Medicare and other insurance options. 6, downsizing. Downsizing. It may be relevant or necessary to evaluate the need to downsize one's home or living arrangements to reduce expenses. Downsize. Make sure you have enough people in a home which you can easily manage, which you can easily afford to take care of. So these are some of the points of financial alterations in retirement. How about estate and tax planning? 2, estate and tax. Estate planning and tax planning. What are some of the financial alterations required in estate planning? In estate planning, one may need to create a will or trust to distribute one's assets after death according to one's wishes or according to one's desires or will. That's estate planning. Have a will in place to help distribute assets after death. 2, tax planning. Financial alterations in tax planning, one has to minimize the tax burden through legal strategies like maximizing deductions, like maximizing on credits, and utilizing tax advantaged accounts. Tax planning is a legal way in which individuals or institutions can use to minimize tax liability. 3, beneficiary designation. One may need to designate beneficiaries for retirement accounts like insurance policies and other assets to ensure that one's wishes are followed after death. Beneficiary designation. 4, power of attorney. Power of attorney. An attorney to handle your financial affairs if one may become incapacitated. Because during old age, we talked about alterations, one may lose memory and you may not be able to make financial decisions. So it's at that point when one may consider well in advance to appoint an attorney who can handle one's financial affairs during such a trying moment or period. All right. So these are points to support estate and tax planning. Then number 3, family budgeting. Family budgeting. One area is creating a budget. Create a family budget. Creating a family budget. Develop a family budget that include all incomes, that include all expenses, in order to track finances and identify areas for savings. You may also need to have a financial plan, family financial plan. Financial plan, one ought to establish specific financial goals as a family, such as saving for a down payment on a house or saving on child's education and so on. And while developing a family budget, is important to involve everyone in the family. Encourage family members to participate in creating and managing a budget in order to promote financial responsibility. And it is on the basis of such a budget that tracking is possible. You track spending, track spending. This means regularly monitoring spending to identify areas where you can cut back and allocate resources more effectively. Financial education. Number 5, financial education. In personal financial management, it is also necessary to educate family members, including the children, about personal finances and responsible money management. financial education. Then lastly, we have emergency fund. Emergency fund. We've talked quite a lot on emergency fund in our lessons on personal financial management. We've seen why in our previous lessons it's critical to build a family emergency fund in order to cover unexpected expenses and financial hardships. We mentioned that if possible, set aside money in this fund that can enable the family to continue with the normal way of life, standard of living, even when incomes are not forthcoming. Have an emergency fund that can sustain the family for 1 year, 2 years, and so on. And candidates, by proactively managing these financial alterations, you can ensure a smooth transition to retirement. You can protect your assets. You can protect your loved ones through estate planning, through family budgeting, and you can also foster financial responsibility within the family. So these are some of the financial alterations in personal financial management. We've discussed points on retirement. We've discussed points on estate planning and tax planning and family budgeting. That effectively brings the lesson to an end. I'll read you today's assignment. Question number 1. How can individuals effectively plan for their retirement, considering factors such as savings, investment strategies, and potential lifestyle changes? Number 2, what roles does estate planning play in ensuring the smooth transfer of assets to heirs, and what key considerations should individuals keep in mind when creating an estate plan? Number 3, how does tax planning contribute to an individual's overall financial strategy, and what tax efficient strategies can individuals implement to optimize their financial situation? 4, in the context of family budgeting, what are some of the practical tips for creating and maintaining a budget that accommodates both short-term financial goals and long-term financial well-being? Now, I would want to encourage you to get a copy of the Financial Management Revision Partner, which compiles KASNEB past paper questions and solutions. Ensure that at the end of every lesson like this, at the end of every chapter, the way you have finished this chapter, go to the book. The book is topically arranged. We've arranged all past paper questions topically up to the most recent KASNEB sitting. At the end of every chapter, make sure you carry out a revision. Answer the questions that are provided in the book. This arrangement, topical arrangement, makes it easier for you to revise. The answers are provided at the back of the book. Before looking at the answers, ensure that you attempt the questions on your own first, so that you can take advantage of the benefits that one may enjoy as a result of active recall. Active recall is an efficient way or method or technique that individuals have used. Is a technique that psychologists have recommended in studying in order to retain information in your memory. I hope to meet you in our next session where we begin on a new topic. For now, bye-bye.